studying your last two. I swim med tea when they turned in. The staring down to mute. And can learn the pole that sunk he died.
Before you can allocate income between provinces using Schedule 5, you must answer one very important question. Where does the corporation have a permanent establishment? Often called a PE. A permanent establishment is a physical or business presence in a province that gives that province the legal right to tax a portion of the corporation's income. In other words, PE determines which provinces are entitled to receive provincial corporate tax. Think of permanent establishment as the starting point for provincial tax allocation. If a corporation has a permanent establishment in a province, then that province is entitled to a share of the corporation's taxable income, and Schedule 5 must be used to allocate the income appropriately. If the corporation does not have a permanent establishment in a province, then no income is allocated there, and that province has no claim to the corporation's provincial income tax, even if the corporation has customers or makes sales in that province. For example, imagine a corporation with its head office in Ontario and a warehouse in Manitoba. Both Ontario and Manitoba have permanent establishments, so both provinces receive a share of the taxable income. However, if the corporation simply sells products to customers in Alberta without having an office, warehouse, or other business presence there, Alberta does not have a permanent establishment and no income is allocated to that province. The key lesson is that permanent establishment is always the first decision in provincial taxation. Before thinking about calculations, tax rates, or Schedule 5, determine where the corporation has a permanent establishment. Once you've identified the PE locations, the rest of the provincial tax allocation process becomes much clearer. One of the biggest challenges in provincial corporate taxation is knowing what actually creates a permanent establishment. Fortunately, the basic rules are straightforward once you understand them. A permanent establishment is generally created when a corporation has a real business presence in another province. The most obvious example is an office. If your company opens an office in another province, that province has a permanent establishment. A branch or factory also creates a permanent establishment because it represents an ongoing place of business. Similarly, a warehouse or inventory location can create a permanent establishment if products are regularly stored there and orders are fulfilled from that location. Another situation that many beginners overlook involves employees or agents. If an employee or agent works in another province and has the authority to negotiate or sign contracts on behalf of the corporation, that can also create a permanent establishment, even if the corporation doesn't have a traditional office there. Now let's look at what does not create a permanent establishment. Simply selling products to customers in another province is not enough. For example, an Ontario company may sell products online to customers in British Columbia. If the company has no office, no employees, no warehouse, and no other business presence in British Columbia, then it does not have a permanent establishment there. This is one of the most common misconceptions among new tax preparers. Sales alone do not create a permanent establishment. What matters is having a genuine business presence in the province. Whenever you're unsure, ask yourself a simple question. Does the corporation actually operate from this province? Or is it simply selling to customers there? That one question will help you identify permanent establishments much more accurately. Determining whether a corporation has a permanent establishment isn't about guessing, it's about asking the right questions. This is exactly how experienced tax professionals approach every corporate tax return. Start by asking whether the corporation has an office in another province. If the answer is yes, then a permanent establishment clearly exists. If not, Ask whether there are employees or agents working in another province who have the authority to negotiate or sign contracts on behalf of the corporation. If they do, that may also create a permanent establishment. Next, determine whether the corporation stores inventory or operates a warehouse in another province where orders are regularly fulfilled. In many situations, that can also establish a permanent establishment, even without a traditional office. Finally, if none of these conditions exist and the corporation is simply selling products to customers in another province, then a permanent establishment usually does not exist. Remember, customers and sales alone are not enough to create provincial tax obligations. There are several common mistakes that beginners should avoid. Many people assume that sales automatically create a permanent establishment. Others forget that agents or representatives can create one, or overlook warehouses and inventory used to fulfill customer orders. Another common mistake is starting Schedule 5 before first determining where permanent establishments exist. Today's business environment makes this analysis even more important. With remote employees, e-commerce, third-party warehouses, and business representatives working across Canada, a corporation may have a permanent establishment even without opening a physical office. The most successful tax preparers don't begin with tax calculations. They begin by understanding the client's business operations and determining exactly where permanent establishments exist. Once that foundation is established, the rest of the provincial tax allocation process becomes much more accurate and much easier.